When you hear the term cash advance, the first question that usually pops into your head is simple. Does taking out a cash advance directly reduce or negatively affect your bank checking or savings balance? To answer that question clearly right away, the simple mechanics are straightforward. Taking a cash advance does not automatically drain or subtract money from your bank account balance. In fact, if you transfer a cash advance into your checking account, your visible liquid balance will temporarily go up, not down. However, looking only at that surface-level number creates a massive financial illusion. While your bank balance may look fuller in the short term, a cash advance triggers a powerful chain reaction behind the scenes that can quietly destroy your real net worth, drain your future bank balance through hidden fees, and lock you into a compounding debt trap before you even realize what hit you. To understand why this happens, you have to look at what a cash advance actually is compared to a standard withdrawal. When you use a debit card at an ATM, you are pulling out your own hard-earned money that already sits in your bank account. The balance drops, but you owe nothing to anyone. A cash advance, whether taken from a credit card or a short-term app, is fundamentally different. You are borrowing money against a line of credit. It is a short-term loan that carries some of the most aggressive, expensive terms in the entire consumer finance world. The core problem people face when they turn to cash advances is a fundamental misunderstanding of how these transactions are processed, structured, and repaid over time. Many people turn to a cash advance when they face an immediate financial squeeze. Maybe rent is due, an unexpected medical bill pops up, or the car breaks down right before payday. In that moment of panic, seeing cash hit your checking account feels like a lifesaver. The immediate fear of an unpaid bill or a bounce check disappears for a brief moment. When you buy groceries or gas with a standard credit card, you usually get an interest-free grace period of around 20 to 30 days to pay off that balance before any interest charges are added. Cash advances do not work like that. The moment that cash is disbursed to you or deposited into your account, the clock starts ticking. Interest begins accumulating on day one, minute one. To make matters worse, the annual percentage rate, or APR, applied to a cash advance is significantly higher than your card's standard purchase APR. On top of immediate, high-interest accrual, you are hit with upfront transaction fees. Most credit card issuers charge a cash advance fee that is either a flat dollar amount, usually around $10, or a percentage of the total advance, typically 3 to 5%, whichever is greater. If you take out a $500 cash advance, you might instantly owe a $25 fee before you even walk away from the ATM or exit the banking app. If you use an out-of-network ATM, you also pay the ATM operator fee and your own bank's fee. This leads directly to the question of how this ultimately destroys your actual bank balance in the long run. When you take out an advance, you establish a debt obligation that must be repaid out of your future income. When your next paycheck arrives in your bank account, a massive chunk of that money must immediately leave your account to clear the advance, the upfront fees, and the daily accumulating interest. If you only pay the minimum balance required on your monthly credit statement, the bank applies that minimum payment to balances with lower interest rates first, under standard consumer credit payment allocation rules. That means your high-interest cash advance balance continues to sit there, compounding day after day, sucking more and more money out of your bank account every single month. There is also the secondary impact on your credit utilization and overall financial health. A cash advance instantly inflates your credit card balance, which drives up your credit utilization ratio. Credit utilization accounts for about 30% of your standard credit score. If taking that advance pushes your credit card balance above 30% of your available limit, your credit score takes a direct hit. A lower credit score makes future borrowing far more expensive, increases insurance premiums in many states, and can even impact housing applications. What started as a quick fix to boost a low bank balance creates a long-term drag on your entire financial profile. The fear that drives people into this cycle is completely understandable. So, what is the actionable takeaway here? How do you protect your bank balance from the damage of current and future cash advances? First, if you currently have an outstanding cash advance, your absolute top priority must be paying it off immediately. Do not wait for the monthly statement, and do not settle for making minimum payments. Pay down the exact amount of the advance as fast as humanly possible to freeze the daily interest accumulation. If you carry multiple balances on that credit card, pay more than the minimum requirement so that the excess funds are legally forced to go toward the highest APR balance, which is your cash advance. Second, if you are currently tempted to take out a cash advance because your bank balance is dangerously low, stop and evaluate lower-cost alternatives. Check if you can access a small personal loan from a credit union, request a payroll advance directly from your employer, negotiate a payment plan with your service provider, or sell unused personal items for immediate cash. Almost any alternative carries fewer predatory fees and lower long-term costs than a traditional credit card cash advance. Finally, structure a permanent buffer inside your checking account. Building even a tiny emergency fund of $500 acts as a financial shock absorber. It prevents temporary timing mismatches between your bills and your paycheck from turning into high-interest debt emergencies. While a cash advance might temporarily disguise a low bank balance today, true financial stability comes from keeping your actual income in your checking account rather than renting cash at exorbitant rates from a credit card company. Understanding these mechanics gives you the power to break the cycle, protect your hard-earned money, and build a bank balance that stays healthy for the long haul.